Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 216. In this episode, we're going to tackle the consumer sentiment about buying a house. It's up. People are feeling better, yet those that want to buy right now are still at an all-time low. We're going to talk about that and the word affordability and some options and more on this episode at What's Your One More. All right, so welcome back. Let's just get right to it here. So recently, Fannie Mae released on November 7th their Consumer Home Price Sentiment Index. They do this every month. And this is where they do a survey of potential homeowners and current homeowners about how they feel around the market. Are you ready to buy? Is it a good time? What's holding you back? How do you feel about selling? And why are you not wanting to sell? And what's the percentage of those that want versus that do not want to sell? The survey showed a couple of different things. The actual sentiment, right? The sentiment of like, hey, I think it's becoming a better time to buy. That actually was up on a 2-year high. But those that were willing to buy right now is still in a very low frequency. At 20% of the people surveyed said, yeah, I would buy a home right now. And that's still relatively low. And I think the reason behind that is it surrounds the word affordability, as rate was one of the major objectives for those that did not want to buy. And home prices still rising concerns some people. But I think at this point, we may be numb to the rising of the home prices. It goes back to the inventory, the supply, the demand. We've talked about that. But I think a staggering statistic that came out of this survey was the fact that it had risen to a height that hasn't been seen really since February of 22. And if you recall February 22, what was going on at that point? Well, we had lower interest rates. We were coming out of very low interest rates, and we were starting to see a rise in interest rates. And that is good because now we see consumers getting back in the market to where they feel comfortable about, hey, I want to be a homeowner again, and not necessarily resenting the market. This tells me they've settled into home prices, but affordability is still an issue. And why is affordability an issue? Well, obviously, interest rates and home prices attribute to that. But I think the lack of supply is really important. You know, we talked about builders and the conundrum on the last episode with the labor market. But one of the things I wanted to touch on here was how undersupplied, how significantly undersupplied new builds are. And here's a couple of outlets that recently released their numbers. And while they're all over the place, even if you take the lowest of ones and then the highest, this is a ridiculous amount of inventory that we're behind. Bloomberg suggests that we are somewhere between 4 and 7 million homes short for the demand in the country right now. CBS is suggesting that we're 5 million homes for sale or rent short to satisfy the current demand. And, you know, when I look at that, NBC News is suggesting 5.5 million units short of homes for sale or rent. That's a significant amount of numbers. Like that, and the demand is there for that. That's why you're short that. How do you satisfy that? Like, where do you turn to for that? And I think that is something that's driving these home prices continuing to go up. And, you know, we've gone down the path over and over again with the YouTubers online and all the stuff they've said about the housing market. And we did a whole episode debunking for the last really 14 years why this market hasn't crashed and why you're not going to see one. But the reason the new builds are so backlogged, this dates back to 2008, really. We talked about that on the last episode. But, you know, when the builders stopped building during that time, whether they, you know, went bankrupt or they just stopped building and put things on pause, we've never recovered as far as a trajectory of where we should be building to subside the demand. We've never recovered for that. We've always been behind. We've been talking about that for pretty much the existence of this show, how far behind we are. But when you see these numbers, I think they're kind of eye-popping, and I think they're astonishing. So, like, if you're a home buyer, right, and you're in this market and you're going, hey, I think I'm going to wait. Like, it's imagine trying to go buy a vehicle and they stopped producing vehicles for some sort of period, like all vehicles, not just like one particular one. All production of vehicles just stopped, and all you had was the inventory that's out there. That's it. We kind of saw a little bit of that during COVID. You kind of got a glimpse of that, but you saw what happened to car prices. I mean, they went through the roof. Oversticker, you go on and on. Well, as the factories, you know, fired back up per se, and they were able to subside that demand, granted, the analogy is that the more they produced, the more the price came down. Homes take longer to build than cars. I get it, but you get the point is that you can see how quickly a price can rise and how quickly it can come back in line. Well, they weren't 4 to 7 million short on cars. That's not what was happening there. Homes is a different situation. And so I think that until we level off that supply, you're going to continue to see this type of uptick and rise. And I know those are argue with me. I know that. And then you're entitled to your opinion. I respect it. But I haven't seen a factual set of data to suggest or to convince me yet that these home prices are going to go backwards. I see a lot of emotion I do see that. There's a lot of emotion that's used in the argument or the conjecture of why home prices are going to go back, but emotions aren't facts, right? And so it was interesting to me. Zillow just released their most affordable places to buy a home. This was interesting to me as I kind of go through the markets. And obviously, we talk about what makes homes affordable: property taxes, insurance, price of the product, interest rate. Well, you can't control the interest rate, but you can choose the price. And then obviously, based on where you buy, the taxes and the insurance are going to be hard cost. In some areas of the country, as we've described on this show, are far more favorable than others when it comes to that. But when we get into the most affordable places to live, I thought this was interesting. Here's a couple of markets that I'll throw out there were interesting. 12 metros, they said, where at least 50% of the listings are considered to be affordable. You've got Pittsburgh, PA, you've got St. Louis, you've got Buffalo, you've got Detroit, Michigan, you've got Indianapolis, Baltimore, Cleveland, Birmingham, Cincinnati, Philadelphia, Kansas City, and Minneapolis, all meeting that criteria. And as you'll see on the chart here that is in our YouTube channel at What's Your One More, you'll see all the home prices on the side as of late August 2024 and what they've done. So that'll be in our YouTube channel at What's Your One More if you want to check that out. However, there were some other metros that were gaining affordability on listings. And I thought this was interesting too, because these are what they would call up and coming cities, right? They're not quite there at that 50%, but they're rising significantly to catch the attention. And, you know, for me, these were complete polar opposites of the ones that I just mentioned: Austin, Texas, San Antonio, Texas, Phoenix, Arizona, Minneapolis, Minnesota, Atlanta, Georgia, Jacksonville, Florida, Dallas, Fort Worth, Texas, Virginia Beach, Raleigh, North Carolina, Houston, Texas. Now, the reason I wanted to point those out is the Texas market in particular, Austin, they've been taking a little bit of hit in home prices. So the recovery, I think, and the affordability is natural there. But when you take a look at some of these other ones, you know, the Sunshine Belt, if you may, became very populated during COVID, and home prices rose dramatically during that time. It's interesting to see that some of those are becoming more in the affordable trend market for home buyers on this. But when you turn and take a look at the National Association of Real Estate Agents, one of the things I want to point out on here would be Lauren Sheeran, who is their chief economist. Lauren Sheeran, what he did was he came out and said, hey, listen, in his recent forecast at their big rally, he thinks 2025 is going to be almost a 9% increase in transactions in 2025. And, you know, he's pretty good with his spot on with his assessment there. I think in 2020 and 2021, we were all spot on, but 22, we were all wrong, and 23, we were all wrong. But he's been spot on. And he said 13% increase in 2026 in residential purchase transactions. I think that's a big win, but I think he's hanging his hat on the interest rates, right? I think we all are. We just did a whole episode right before this on 215 about why we think rates are going to drop 200 basis points. But we're not the only ones, right? He clearly does too. And another graph on here shows a trajectory of 25, 26, and 27 of real estate investment increases. And that's in our YouTube channel at What You Want More. But significant increases in here with some complete confidence in interest rates. And I don't think if you look at this rise in the rates that have happened here recently over the course of November, if you also look at the dips that have happened, and I'm just talking about between really the last quarter and a half, where there are dips, transactions go up. And it's not even close. I'm going to put another graph in our YouTube channel here at What's Your One More. And obviously, this is a graph-heavy podcast, so check us out on our YouTube channel. But when you see these dips in the conventional conforming rates and the 15-year rates, you see transactions go up. And those go hand in hand. Imagine a window where the rate just continues to go down. Imagine a situation where every Fed meeting, it's not a matter of if they're going to cut, it's how much they're going to cut, because that's the era we're entering right now. And if the labor market doesn't perform and remain resilient, then that's going to be even more cuts at a rapid rate. But imagine an era where you go, hey, listen, Fed meets every 6 weeks, cut. Rates continue to move with that. The evaporation of the 10-year disparity and the 30-year rate start to get back to normal levels because of the confidence in the market. I guess where I'm going with this is imagine when we do get down to the upper fives. Imagine that, because that's going to happen. The smoke signals are no longer smoke signals. There is a light that's clear at the end of the tunnel now, and you know it's coming, especially after Powell's comments at the podium. His desire to get to neutral, which it was the equivalent of a 6-month core PCE at 2.3, leads us all to believe that there's almost 230 basis points to be cut. Imagine what life looks like when we get into the fives. Who knows? Maybe the lower fives, upper fours. I'm not saying it'll stay there, but it could happen. What does the home prices look like at that point? what do the transaction counts look like at that point? And I think that's why Lawrence Yun can confidently say, hey, listen, we're going to see almost a 10% increase in transactions in 2025. Now, I have some friends that I debate this with, healthy debates, have some great conversations. They don't believe rates are going to get below 6.75. They think we're going to live in a range between 6.5 and 6.75 for the duration of 2025. Okay, I could see that happening. But I think in order for that to happen, it would require no more Fed cuts. It would require the labor market to strengthen. It would require inflation to rear its ugly head at a dramatic rate, not an incremental rate, at a dramatic rate. And it would also require no pressure from the incoming administration that wants lower rates, that history has showed that they tend to get what they want when they get in there. And also the fact that Powell's term is up in 26. So if he doesn't cooperate with the current administration, and I'm not saying they're strong-arming him, but if he doesn't cooperate, he's probably not going to be there, and they'll put someone in there that will cooperate. So I don't think for a second that we stay at those upper sixes. I think there's a fair argument to say you'll live somewhere between 5.5 and 6.25. I think I could buy into that, right? I could see that as an average or a blend during 2025. But even if you get anything with a 5 handle on it, going back to the beginning of this podcast, the consumer sentiment shows that you get a 5 handle on a mortgage rate, all of a sudden that 20% that thinks it's a good time to buy now jumps to over 50%. And that's a significant increase. And that doesn't even include the people that are sitting in waiting for that moment going, all right, give me the 5.5, give me the 5.875, and then I'm going to get the equity out of my home. Because equity's at an all-time high. And we've talked about that over and over again, this lock-in effect as well. This will be a tremendous amount of transactions. And as we kind of see in December, I think by now it's a foregone conclusion you're going to get a quarter rate reduction. You're definitely going to get one in January. I mean, if you take the next 8 meetings and you do, I guess, the next 9 meetings, you take December plus all 8 next year, and you just did a quarter, that's 225 basis points. There's your 230 right there that I just described, right? To get you to that neutral number of 230 that, or 2.3 that Powell was describing. This could be an opportunity to see those rates maintain at the 5 range for a significant amount of time. And as we've seen over the last 12 months, the hunger, the thirst in the market to get that rate, to get something with a 5 handle on it is there. And there have been those that have done a very good job of timing that out. There are those that have missed it and said, I'm just going to wait. Yeah, that's great. But I'm telling you, in stats and data sets that we're looking at, when we get there, these transactions go. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. So going back to the beginning of the limited inventory, right? We're anywhere between 4 and 7 million, those pundits, CBS, NBC News, Bloomberg, said we're 4 to 7 million undersupplied on the new build side. And we all can agree that new build backfills inventory. It creates new inventory. If we're not building enough, we're not getting more inventory, thus the supply conundrum. What's going to happen when those rates get down and that supply, it's not going to get back. I mean, it's going to take years to backfill that. What's going to happen when that demand comes to the market? We did a whole podcast, probably 10 plus episodes about generation and the age groups and the population and the homeowners and the first-time home buyers and the buyers that never capitalized on being a first-time home buyer that are still like sharks circling the water, waiting for that moment to get that house. Is it fair to think that you could get back to a 2021 situation where people were lining up to get to a home, where people were putting in blind offers, people were putting in 13, 14 offers on a home? I mean, think about it. If you were an agent, it wasn't uncommon to have 13, 14, 20 offers on a home. Why was that? Was it because of COVID? Do you really think COVID caused 20 offers on a home? I think you could argue and say people had to live in their homes and there was nowhere to go, so the focus and attention turned towards housing. But could you argue that demand was always there? It just became accelerated because rates got lower and people felt more comfortable, and knowing they had to work from home now, they needed a little bit more space. So it altered the lifestyle, right? Is it fair to argue that? I guess where I'm going with that thought process is the demand hasn't changed. The pool has actually gotten bigger. The supply has actually shrank. It's not increased. And if rates come down and subside the affordability concern, you're going to see that musical chairs of homes being purchased that we've talked about, where everyone's buying and there's going to be someone that's left out. And you're going to continue to see that happen as rates go down. It will also stimulate the economy. It'll also improve the labor force on the residential labor workforce side, which is very important from the last podcast we just talked about. All those things contribute to the health of the market. And I think it's vitally important that if you're a buyer, you recognize the moment that you're about to go into right now. You know, because right now there's buyers. There are buyers that are literally saying, oh, this home's for sale for $500. Let's go offer them $480. Like, stop wasting your time with that. Like, that seller is not even going to entertain that offer. And then you wonder why the seller didn't even comment or reply back, because they know now. Yeah, you can argue it's not a seller's market right now. You can argue that. But inside that sentiment, 67% of homeowners said now's not a good time to sell. Well, why do you think they said that? Because they're getting bullshit offers like I just described. They don't need to sell. They've got a 2.5% to a 4% interest rate. We know 90% of the country has those low interest rates. You're not going to strong arm or lowball a price if there's not a need, meaning there's not a divorce or a death in the family. You know, if there's not a reason for that transaction to have to take place, it's not going to take place. And what will happen is the seller will end up winning in the long haul, because they're going to say, well, I'll just wait. And when they wait, the home price is going to go up. Rates are going to come down. That same buyer might not come back, but another buyer will, and they'll end up paying more than the $500 it was originally offered for. Where I'm going with this is, if you're a buyer and that's your mindset, you need to change it if you want to be a homeowner. If you're a residential mortgage broker, get ready, because the wave is starting now. You know, we lost half of the residential mortgage brokers. Thank goodness. We lost half of them out of the business. Yeah, I'll cheer for that one. That unemployment stat, I'll cheer for. It's when your competition goes out of business or gets out, you cheer for that. But I mean, from peak to now, half the originators are out of the business. From peak of February 2022 to now, half the originators are out. That's a win. Probably not the same for real estate agents. You still got some hanging in there while they've seen a decline, but not enough have gotten out of the business yet. And I mean, if you're a real estate agent, you probably agree with that comment. This cleanse that you've been waiting on probably needs to happen, right? The transactions are not, there's not enough of them to satisfy as many agents that are out there. There's not enough transactions to satisfy the mortgage lenders that are out there right now as well. However, that's coming. So if you're a mortgage lender and you're still in the game, hang on. Get your systems in order. Get your team in order, because the wave is coming, and prep everyone. It could go from all different directions of refinances to purchases, but it's going to come. If you're a real estate agent and you've been doing this for some time, you know what I'm talking about. Get your systems in order and get your teams in order, because you're going to see the wave of business come in 2025. Listen, we could be doing this podcast in March or April, and you're going, hey, Quinton, what about this wave, right? We're in seasonality right now, all right? So let's go ahead and let's acknowledge that we're in seasonality. Typically, these are not the most abundant transaction times coming into November, December, January. You're fighting for your life in February to skyrocket in March. That's how it works. However, if you're a mortgage lender, you probably notice your applications go up in January and your transaction counts go up in March. That's always happens that way. That's by design. Take out COVID 20 and 21. 21 and 22. It always happens that way, because first of the year, new high hopes, goals have been set, aspirations of being a homeowner, applications, credit pulls go up. You match those aspirations with contracts in March, and that's when you have transactions that start to go up in March and April. So what I would say is, let's revisit this conversation in April and May, and let's see what it looks like. I'm willing to bet that there's going to be a lot more transactions, and I think we're going to be so busy, hell, I might not even be able to come here and do the podcast. You just don't know. But I do anticipate that 2025 is going to be a very high transaction count year. The consumer sentiment is up. Buyer sentiment is up. Rates are starting to come down. They're going to start to subside, and it's going to be a win for all involved. So if you're a buyer, please listen to what I just described in this podcast. And if you like what you're hearing, you know a buyer, you know someone's looking to be a homeowner, share this podcast with them. Send it to them. Say, hey, listen, don't take it from me. Listen to this person on here. And please share our podcast. We're on Apple. We're on Spotify. We're on Amazon. And obviously, we're on YouTube, as I mentioned about 50 times on the show here at What's Your One More with the number one. So thanks for tuning in. We'll see you at the next episode at What's Your One More.
Got one more shot. I'm going to make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.